Alright, so on June 22nd, there's a. Okay, before I go any further, this is a continuation. So I think we're somewhere up here. So I'm continuing from that part of the course. Anyway, so on June 22nd, there's a higher opening and a gain of about 7 points in the average, most of which held for the day. The volume runs up to 4.6 million. The price is gaining in proportion with a rise in volume. A reaction on the 23rd shows that most of the gain of the previous day was lost, but the bullish indication therein is the shrinkage in volume, nearly one half the activity of the day before. This is a warning sign to sit tight. So this is all just going over this material here, where you have a rally, and I think this is the 19, 20, 21, 22. So you see the rally and then the pullback, and it continues up. Alright, so it continues to do that. On the 25th, we make another gain of 2 points in the average, and the price slumps about 6 points, closing a point below from the low on a volume of 4.3 million. Large supply overcoming and excited public demand coming in as usual. So he's talking about this right here. You have large supply from the high coming in on high volume, and the bar before it just created a lot of excitement. On this bar here, create a lot of excitement. Bang, goes up, public excitement, sell into public excitement. This is distinguishedly bearish. Note the shortening of the upthrust, that is the tendency of the high points to arch over. Well, alright, where is the shortening of the thrust? The shortening of the thrust is actually around here, from this high to high. Note the shortening of the upthrust, that is the tendency of the high points to arch over. Okay. Anyway, the 25th makes a gain of 2 points in the average, and the price slumps about 6 points, closing a point from the low on high volume. Okay. We therefore close out our long trading position and examine our individual charts for stocks that are weak technical position to go short on the next bulge. He's ready to short. Okay. Although the close is near the top, the volume has fallen off to about 3.1 million and the upthrusts are shortening. Alright, so where are the upthrusts shortening? Where's 3.1 million is right there. On this bar, you have a shortening of the thrust. Okay, but really you have to understand what's going on here. You have a break right here on very heavy volume. We're talking about bigger volume than the rest of the chart. That's a lot of volume. Immediately after, it has no follow through and it has a reversal bar. That is also on very high volume. Granted, it's not bigger than the volume before it. It is very high volume, and that indicates that someone is selling as the market is making highs. They sold into it. After that, the market did go higher, but there was a shortening of the thrust and the volume is decreasing. Okay, and again the volume is decreasing here. So volume fell off to about 3.1 million right here, and he's saying that although the close is near the top, which is by the way bullish, the volume has fallen off less volume. So you're taking a bullish indication, which is a close at the top, the volume, a bearish indication, which has fallen, and the shortening of the upthrust. So it's like having one bullish and two bearish indications, and you're trying to weigh them. In the net of these indications are bearish, meaning you have a bullish and two bearish, and you net them. And that's how a lot of this stuff is done. There's no concrete green or red signal, because this right here on most indicators would have given a green signal right there, because I mean, from perspective of strength, or perspective of price action, or perspective of even volume, or making new highs, relatively speaking, whatever this is, this indicators would have given a bullish signal, or they would have given a continuation signal after the reaction. So how do you know this is bearish? Well, you know right after the bar after. Okay, by taking a look at the close, the high, the low, and noting that it's closed below the low, and that's telling you that they're selling into the highs. After that, you have another bar, which is a high-end close, and that is a bullish indication. But however, you're looking at the the high to high, and noting that that is not that is a shortening of the thrust from high to high, and another shortening of the thrust from high to high as the volume decreases. Okay. This outlines a new trading zone we have been tentatively establishing between 137 and 143. On the 27th, the average bulges over a point, narrowing its range to 3.5 points, and closes within a net range of about a 1.5 point on a volume of about 3.8 million. This looks like bidding up to a new high in order to catch shorts. So this is a technique that's used anyway, so we therefore put out some shorts protecting our commitments with stops 1 and 3/8 to 2 or 3 points above the high of June 22nd to 27th. On the 29th, the open is lower and the price recedes to 140. There you go. Now you know, when there's a lot of excitement and markets are very strong, you'll see this type of action. You'll see this when markets are very strong near a high. They have a tendency to have, this type of behavior. You see it in the SPY, in like some prior uptrends when it's extremely strong and it's going up. You watch the reversal area. Alright, so on the 29th, the open is lower. We now observe the average has spent 4 days moving sideways. Moving sideways, very important. Ding, ding, ding. The 29th. We now observe the average has spent more moving sideways, making no further upside progress after a steep rise from the 2nd and following the 5 million share session of the 24th. There has been a steady decrease in volume. In view of our previous deductions, we interpret this to mean that there's a lessening of demand at the top of the rise. So, like, how do you interpret low volume rallies? This is one way to do it, where you see the rise going from high volume to low volume, but by itself I wouldn't say it's bearish, but because of that red bar with very heavy volume, that is something that kind of changes the picture. And also the shortening of the thrusts and the inability to really take out it. They took out this bar, right? This bar closed above that high and it immediately reversed. So I like that. I think that has some clarity. Anyway, in view of our previous deductions, we interpret this mean a lessening of demand. So how is he determining a lessening of demand? By all what I've said before, on the top of the rise. We also know that any further lateral movement or reaction would definitely break the upward stride established on the last phase of the advance from June whatever. Hence, we are ready to sell more stock if we can get them on the bulges. So what he's saying is, given all of this, if you draw a trend line from here to here, it's going to break. Where? Probably there. If you draw a trend line, it's going to break. Alright, let's start marking some of this stuff up. Alright, so this is where you have public excitement. Alright, here actually. So mark that with you have that public excitement here, selling here, lessening of volume at the top, which is your lack of demand. At the top. Okay. Now again, it's only because there's supply in the background. If it kept on going higher and there was no shortening of the thrust or whatever, it would be a difficult case to prove. So he's ready to short the bulges because of those indications. On the 30th, the average declines nearly 3 points to 137 on volume, about the same as the previous day. The market is still at 137 zone, but has now dropped out a sharp upward angle, which it rose from the 19th to the 27th, showing exhaustion of buying power. So he's saying that over here, there's exhaustion of buying power. Now, I think that's basically by the lack of demand up here. All right. Low volume on the 2-day dip to the bottom of the range of 137.43 suggests we may anticipate an effort to rally up. So, lack of demand but low volume. Pull back. Expect rally. Okay. The way the market behaves on the expected rally will probably help to confirm or it may contradict our positions. So we await developments. I think that's an important line because it's very strong. Okay, so if you short, you're going to short the strength. And it's not easy to do. Let's just be real. You have rally. Most people will, what most people do is they're going to mark this area right here and they're going to look to buy it. Why? It's a breakout and test a breakout. So in order to catch the top and try to short the top with this type of strength, it's not easy to do because especially if you're trend following, it's not easy at all. And also because this high volume, this is a different case. This high volume does indicate that it can indicate many things because it would have been better if it just dropped afterwards. So it's really important to be able to accurately identify what this is doing. In my opinion, like the bar that tells everything is this bar, the break right there. That's telling you that, okay, we got a problem. Alright, so anyway, he's saying also that he has all these indications, but he wants to wait for further developments. July 1st, there's a wide spread in price, nearly 2 points higher. Volume shrinks to 1.7. On the 2nd, the market narrows to 3-point range for the average, and the close is 1.5 points lower. On reduced volume, increasing dullness, lower close, and less volume indicates lessening power on the bull side. On the 3rd, there is another attempt to rally. Okay, and the average reaches the old 143 supply line. Okay. At the upper edge of the trading zone, closing about 3 points higher, but volume is not measuring up to the standard of previous rally days. Nothing to be afraid of. We sell stock short on this rally, which is the bulge we are waiting for, placing stops or as below the danger point or above the danger point. July 6th, so he's ready to short into this bulge. Okay, now he does see an increase on volume, and that is on, I think it's the 3rd. So let's see. On the 3rd, there is another attempt to rally, and the average reaches the old 143 supply line at the upper edge of the trading zone. Okay, but the volume is not measuring up to the standard of previous rally days. Nothing to be afraid of. We sell more stock short on this rally, which is the bulge we've been waiting for. Placing stops as before above the danger point. July 6th, 2-point range for the average closes nearly 2 points down on 1 million shares. We read this as indication that the rally of the July 1st or 3rd could not be sustained. 1st to the 3rd could not be sustained, and that the tendency toward narrow swings, heaviness, and dullness is the result of the market having become saturated with offerings. So he's talking about dullness over here. So let's bring that. Okay, so there's dullness there. Anyway, so it's saturated with offerings, all bearish. The average is now on the hinge and on the springboard for an important slump. That is what's important. Okay, you have dullness and all of that, and it's on a hinge or the springboard. So again, reading these indications together, you have public interested, they're bought in already. You have selling to the public. You have 2 bars bid up on low volume that are immediately reversed and goes down. Then you have a rally, you have a pullback on low volume, you have a rally on a slightly increasing volume, and it has no follow through. And instead you have no follow through, and at that point you're on a hinge. Now I don't recommend doing all of this, which is by all of this I mean this thing right here, because I think this is used incorrectly, the patterns like that. But that is the springboard. Okay, that right there is the springboard. Alright, but what I'm seeing is a lot of folks are just drawing triangles, and you have to be careful about just doing that, because then you're going to go and get into the trap which the brokers want you to get into. You know, they want you to do this, which is just draw, this, and not exercise judgment. Basically 2 things. A, misinformation, which is, using just anything that's very, very simple, that's easily people can, do. And forgot the other one. Anyway, but this is indicators, meaning to replace your judgment with mechanical rules, because markets do not follow those rules. Markets are not quantitative, they're qualitative. Alright. Breaking volume. The market is now out of its former trading zone on the downside. Alright, so this is the decisive break. What he calls the decisive break. The market is now out of its former zone on the downside, and the volume indicates that liquidation has been resumed. Liquidation has been resumed. It's very clear right there. And liquidation. Resume. Okay, I'll be back. So the liquidation has been resumed. There you go. Thus the rally has run its course after the averages into the lower edge of its old December support area. And we must assume that the next test of the market will be around the levels at which support was rendered. 122. I think he's looking right here. If large interests who bought on the second and third and who undoubtedly distributed their holdings during the high market of last week are willing to take back near or above the previous low levels, it will be an indication of their confidence in the future and a sign that the bear market is over. If there is no such sign, we conclude that the bear market has resumed and that the June recovery was only an interruption of the main trend. Basically, a counter trend. We are on the short side and shall occupy that position until we see some reason for changing it, either to neutral or a bullish side, or the bullish side, bull side. Okay. Da, 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 da. 122. So he's looking at this level here. So the large interest who bought here, he's looking at these guys. Okay. Alright, so what he's saying is you got a bunch of you got strong hands who bought this low. He's looking for them to buy here. Meaning as the market goes down, he's looking for them to buy in this area. If they don't and it breaks, he's looking for the bear market to continue. Alright. Let's continue to the next one. A 2-point further loss on July 8th, a small rally on 1.5 million share volume during the 9th and 10th, then a dropping off on the 15th of the average, nearly touches 126, a 19-point decline from the top. On this day, price spread over 4 points from the high to low and closed significantly above the middle of this 4-point range on 2.6 million, minor selling climax. Alright, so basically it's pulling back and you have volume, increased here. It's going down, 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 and bang, right there. So he's calling this a minor selling climax. And again, I know like everyone thinks climax end trends, but the end swings as well. And that behavior can occur at the top and bottom of a swing. And these are his words. I'm not making any of this up. As you can see, that bar is a climax. His words from the original course. There is no follow through on the downside next day, instead a quick rally and a high and close. Thus we have two indications which might lead to a rally. So We have, what is it? No follow through, high and close. No follow through, high and close, bullish. Alright, but that will be normal occurrence after a decline of 19 points. So basically, he's saying, alright, you might have a rally, okay? And if you see the rally as a pullback, you're going to look at that halfway point, and obviously this area right there, right over here, that break. It basically goes halfway back. Alright. Okay, so you may understand how to handle your money, and may recognize the hazards in carrying stocks up and down through the intermediate bull and bear markets, a procedure that causes so many heartbreaking losses. The following general observations I introduce at this point. The relatively small volume on which the market is now declining tends to lull the public into a spirit of indifference towards the market. But contrary to popular impression, the low volume accompanying the steady downward drift is bearish, not bullish. Ooh. So where did he mention this? Here, the relatively small volume on which the market is now declining. Right here. Points. I think he's talking about this right here. What's he saying? Is steady low volume decline is bearish. That's what he's saying. That low volume decline here is bearish. This is kind of difficult because you have strength in the background and you're looking at the low volume and thinking it's a low volume pullback. So it's not a low volume pullback. It's a springboard at the top, a break, and a low volume decline, which is steady. And he's saying that this is a spirit of indifference in the public. But contrary to popular impression, low volume accompanying a steady downward drift is bearish, not bullish. The small volume is explained by the fact the majority of people are constitutionally bullish. They can always be induced to buy stocks after the market has been advancing for some time, or when everybody else seems to be buying. But as pointed out elsewhere, they fear to sell short and hence will not participate in a bear market as experienced operators do. Consequently, the volume of daily grows smaller during the progressive stages of a bear market. So what he's saying, lack of public participation. All right. Lack of public part. Lack of public. Just write lack of public. So here you have a lack of public participation, and that low volume. You have a break, and then you have a lack of public participation, which is different than saying that supply is weakening. Supply is not weakening. It's buying that it just isn't there. Okay, that means the public is not buying here. I think they got exhausted up here, saw the break, and don't want to buy, and it's just going down. Increased dullness, lower close, and less volume indicate less power on the bull side. On the third, there's another attempt to rally, and these averages reach the old 143 supply line. Where am I? Okay, next chart. Alright, so that steady decline is actually, I think it's this. All of this. Okay. Anyway, now that the rally is over, August lows. So it tags this area. This is the steady decline on the low volume here. Okay. And dies out at about August 15th. Okay, moving on to the next. It recovers weekly and on small volume from this critical support level when it began a new downward march at a very sharp angle. The volume rises to about 2 million and stays fairly constant at that figure after breaking through 120. 120. Okay. That was your break right there. Okay, so this again shows heavy liquidation. So on September 18th, volume increases to 3 million shares, and on the 19th to nearly 5 million. The great increase in volume from less than 1 million in late August to equivalent of 5 million is our warning to move our stops close to the temporary rally tops and to be on the lookout for a sharp rally or turning point. That he's saying, be careful. Prices have gone down a lot. Alright, to put it another way, the public which came into the market and bought freely around the tops of the February is now loaded up with stocks at the highs. Its buying power accordingly is exhausted. These people will not liquidate until compelled by necessity, because on the one hand they fear the market might go up again, and on the other they're wishing and hoping that it will. Instead of recognizing the danger and philosophically adapting themselves to the logic of the situation by cleaning house and accepting some losses so that they may have buying power to repurchase, they merely hang on, and those whose funds are not tied up are too frightened to buy. Consequently, volume shrinks and market becomes as a professional affair, except when outcroppings of new weakness forces the tied up long holders to liquidate. Thus, we have both an explanation of little understood market phenomenon and an example of the risks involved. Failing to liquidate promptly on the early warning signs of danger of bull positions, refusing to at least to protect long commitments, and the folly of yielding to a natural impulse to jump into the market when prices are way up and everybody is excitedly buying. Stops on our short position have been moved downward as follows to a level. Okay. Again, stops later. But what he's really saying is, in the background, you had a lot of public enthusiasm. So they bought in, they got exhausted. There was a springboard, it broke, it rallied up, and they were not ready to buy. And then it went down. When it went down after the springboard, it went down on a low volume rally. Low volume rally became a professional affair, meaning the public is not involved or was exhausted, and they're not willing to participate, and they're indifferent, or they're stepping out because they already got trapped, and because of that you have a low volume liquidation as indicated here. Now then after that you have a break over here which continues the liquidation, and you have a 5 million share day right there, which is a warning sign of a potential rally. Okay. So again, think around here, September 21st. Okay. So this 1 bar wonder over here, the warning sign for this was right here. Alright, so this climax warns of a rally. And you get that rally. The rally comes on the 23rd and gives us an opportunity to sell short again while the market is still strong, or when we see the rally is failing. So if you're going to short this, you have to wait for the rally to fail. Such an indication is given by the way it rallies on 23rd. On this day, the average recovers nearly 1.107, closing at 105 and a half, but the volume falls to under 3 million. And we therefore suspect that it's merely due to shorts who try to cover at once. So again, these violent spikes are the result of short covering, but the key here is there's no follow through. Okay, such a rally is too effervescent, an effervescent rally. Okay, where the rally falls on volume. Okay, well, that's interesting. Rally short covering. No. So that bar here tells you more liquidation is coming. Why? It's not on low volume and it's pretty strong. That's why. So again, basically what's happening is you have this rally, it's not confirmed, and basically have like this dead center again, and there's weakness in the background, and it's basically consolidating after that weakness. That's what that is. Up, down, consolidation, and let's see. Here is where you have that increase right there. So you have that change of behavior right there, and you have a pullback or a higher high, higher low. All right, the close isn't bullish, but everything else, the high and the low is, and it's actually on lesser volume. Wow. Okay, that right there is the follow through. Higher high, higher low, higher high, higher low, higher high, higher low. Bingo. This right here is a strong rally that you're looking at. Over the next 3 sessions, there is a rebound from 79 to 99. The rise on October 9th breaks the downward angle of decline. So again, he's looking for trendline break by placing a ruler. You'll see that on the 10th, the market narrows, volume falls off to 800,000. Okay. From what we have learned by a preceding study of the chart, we recognize this indication as a sign of a reaction, which comes on the next 2 days when the average reaches 88. Okay. Right there. A point over the normal halfway reaction. So he's looking at the halfway back, observing on the 14th that the market dips back to the supporting points of October 7th. What is this? Okay. Alright, so he's looking at this. That's what he's looking at. Ding ding ding. LVP. Low volume pullback. Comparative light volume, we decide that, okay, let's see. We've got to use the wave chart later. Okay, so now he sees this. He wants to take a long position. So what's he doing? We do not take an investment position. However, because we would like to see a period of dullness in preparation for a bull market, which normally after such a decline should begin somewhere about this level. To say that it will begin would be a guess. So on the 15th, after rallying the previous day high, the average reacts, but a decrease in volume. Higher close and higher low tends to confirm the performance as completion of this secondary reaction. What? On the 15th? So this is the secondary test. So on the 15th, you know this. Right there. Saying it's a higher high, higher low, higher close. And that confirms the test. Okay, so after this bar, you already know there's a pullback going on, but after that bar, which has a higher high, higher low, and higher close, it confirms the secondary test. And what else? You got a climax right there. So you have diminished volume followed by climax, indication of the next 2 days as the average reaches the previous resistance point. All tells us to get ready for a pullback. Okay. Let's go there. Right, so you have that low volume rise over here, bang bang, going down, and then pop. One day wonder has a lower high, lower low, low close. Gotta mention no follow through. Confirming the climax. And that tells you that there's going to be a pullback. And then finally, in the next 3 sessions, the market swings to a dead center. So I think he's talking about like right there. So he says there's going to be a pullback because it's at a dead center, but also because there was a low volume rally to resistance, followed by a climax, followed by a lack of follow through on the upside because there was a red bar, and then it kind of hinges dead center. That's confirming that, yeah, there's going to be a pullback. Okay. and you have a break. He's looking for a base around that 85 to 88 level. Let's just draw that out. I think I messed that up. 85. Right there. This is the truth right here. The market can confirm, deny, or do nothing to your judgment. So just be ready for that. October 28th, there is a minor climax right there. At support. This is confirmed by decreasing volume. Okay, good. All right. So let's this shit. Do do do. No. And no PIC. Alright, so this confirmed the climax. Why? There's no progress in the closes, and what? There is no follow through in terms of, I don't know. It's just there's no progress in the close, and there's a lack of volume here. Okay? So let's just write that. shit, I did it wrong. CM and okay. So now he's saying that the zone of support, broad zone of support, very important. Jeez. Okay, so I know this is a very long lecture, but what are you gonna do? Alright, so basically, let me sum it up. You had a downward move here, and it was on low volume, but that low volume means something. What does it mean? It means the public is not participating, and as bear markets continue to go down, there's going to be a lack of participation, so it's a professional market, and the public is indifferent. They're standing on the side, they're stuck, and the market continues to go down. There is a bounce here. I don't think I went into this, but basically it breaks right here where you have a breakout. You have a breakout, and it continues down, down, down. You have heavy volume that came in here that caused a thrust, a rally, but it was a one bar wonder with no follow through, and it reversed on equal volume, not on lessening volume, but equal volume, saying that right there is just short covering. And then the market went down and accelerated down and eventually hit a high point right there. So you had a change of behavior right there. That was followed by a rally higher with bullish indications. Then it pulled back on low volume, and this was a secondary test. The bar right after it confirmed the secondary test because it has a higher high, higher low, higher close. Low volume secondary test. It rallied, climaxed up here at a resistance area. And that was confirmed by no follow through, lower high, lower low, lower close. Hinged, broke, went down. Was a little climax right here, confirmed by low volume afterwards, and the lack of progress in the closes, and then finally it rallied, and this was an area where it met climax, and that was confirmed by lower high, lower low, low close. So there's a lot to this. That's all I got. We're probably gonna finish up this study soon because it's been quite. Oh, I think it's almost done. Again, we have a. Okay, so what he's saying here is at the point of our where our chart ends, it appears at first glance that we are getting a reaction on slightly diminishing volume, which if the market has not exhausted the force of demand stored up, no such effort materializes. However, on the contrary, the average gives an indication of renewed weakness by dropping sharply to 95, and eventually sinks and etc. etc. So hesitation of 5 points. Okay. Again, we have an illustration of vital importance of stop orders. Made a purchase investment. Suppose so that we had let our stops on these commitments run undisturbed, or or it says whore. We originally placed them under the 85-88 level. The worst that could happen to us now would be the automatic closing of our etc. of our whatever. Thus, we have our capital still intact. All he's saying is he got the hell out on the climax. Let's have you carry these. This is probably the end result. You may now see why study of the stock market cannot be reduced to rule of thumb procedure. In other words, rule being the key word. You cannot be a set of rules. Why it is foolish to seek mechanical shortcuts and to draw head and shoulders. From this study, it all comes down to this. You have to employ judgment, and you cannot use mechanical rules. So if you're looking for a rule-based system, or you know what they say, follow your rules. Your rules, markets don't follow your rules. You can try to, but markets will not follow your rules. And two, drawing diagrams like triangles without understanding what's going on, without understanding the background, head and shoulders, all of that, candle patterns, without understanding what it means. And by that, what I mean is, like, without understanding, is the public trap? Is the smart money buying the low? Is it selling the high? What does this low volume mean? What does this high volume mean? Etc. etc. So all of those things, is this bar just short covering? As we saw over here, the bar was just short covering. Over here, what about the lack of fall through? What about this rally? Is this something, or like you have this rally right here, and it does rally. Okay, then it pulls back. There is where they withdrew support right there. It does go sideways and breaks. I don't think I went through that piece right there, but the point is, without knowing what all of this stuff means, it's going to be very hard to trade successfully, which means that successful traders are using judgment. Now, there are many system traders, but there's an audio by Ernie Chan, who is a machine learning and AI and algo trader, and he says that when he deployed the systems, they didn't work. They worked on the back test, but when he deployed them, they didn't work. So, what does that mean? You want to be able to read the market and have intuitive judgment, and know when you're right and know when you're wrong. Done. We're done with the study. I'll be moving on to the next study. Thanks.